All right, good afternoon, everybody. Hope you're all well. This is for educational purposes today, and this credit spread class, we just finished our short-term strategies class, which went 3 weeks. It went really good. Trading was really good during it. That will be available in the archives starting in the afternoon today. We should have that available. That was a really good class. If you're doing shorter-term trades and you weren't able to make the class live, this is the start of a 2-week class. It'll be starting May 9th, Wednesday. We'll go Wednesday, Friday for 2 weeks, 1 p.m. Central. Cost will be $197. All classes will be recorded and archived like they usually are. Each class will be minimum an hour. And the nice thing about all our classes, you'll be able to ask questions, whether you can only watch it recorded, whether you watch some live, some recorded. 2 months after the class, 3 months after the class, you'll be able to watch it and ask questions. Here's a tentative agenda. I'm going to be tweaking it some more, but this gives you at least an idea of some of the things we'll be covering. Tentative agenda subject to change May 9th. I'll be talking about Greeks of stock and index iron condors, criteria for picking the call or the put credit spreads, what strikes to sell and buy, what duration for these trades. During the class, I'll be talking about mainly the indexes, SPX and RUTs, a little bit of SPY, and then some stocks. May 11th will be 4-step risk management plan. How do we manage these trades? May 16th will be dedicated to adjustments, and May 18th will be formulating a plan for a credit spread portfolio to generate $3,000 a month. We could put any number in there, right? But they have a specific plan how I would do it. And so we'll cover a lot in this 2-week class. So here'd be an example as we, how do we look at the market right now? Right now, SPX, at least when I looked at it, might be a little bit different. These slides were from about an hour ago. So as I look at the market right now, we're roughly in this, since January 26th, we've been in this 3-month correction environment, weather condition in the market, which has been characterized by basically SPX between 26 and 2800, though we dipped to around 2580, and VIX between 15 and 25. And that's kind of driving what strategies we do and everything right now. We've had some two-way movement. Right now, we've been in the last week or so kind of testing that lower end of the range. We're down 244 points in the SPX from the January 26th high of 2872. So when I took this slide in the last hour or so, we're about 8.4% off the high. So doing put credit spreads, and that's one thing we'll be talking about in the credit spread class, doing put credit spreads in the long part of your portfolio and stocks you like, geez, a lot of the stocks you probably liked 3 months ago were probably 8 to 10% lower, right? In other words, this is the market environment we're in. VIX definitely higher than it was in 2017, and we have a higher level of VIX, but in the scope of the last 3 months, February, March, and April, because we're almost in May, a few days, this is kind of the middle of the, near the middle of the range of this weather environment. VIX 1880, if you look at most of 2017, would be absolutely very high. But this is the environment we're in, and you're going to get used to it, right? It's just like, again, what we'll be discussing is how do we trade these spreads, right? How do you drive a car in Chicago in February? Is it different than driving it in August when there's no snow or ice? Yes. So this is the weather condition we're in right now. I'll just go over a couple examples of credit spreads. We'll be talking about a variety of different credit spreads. Here's one with a little different setup that'd be 20 wide. So with SPX at 2629 when I took this slide, where's SPX at right now? Where's the SPX right now? Is it around these levels? 2629, 2630. Oh, Bob says 2634. So, we're pretty close. But when I took this slide, 2629, so if I'm looking at a 20 wide put credit spread where in SPX selling the put at a delta of 20, and that would be selling a 25-10 strike, which would be 119 points out of the money for a 30-day put credit spread. And so, and getting a credit of about 270. If you were to do a 30-day put credit spread with picking your short strike with a delta of 20, if you were to do it 4 months ago, when SPX was a couple hundred points higher and VIX was 11 or 12, instead of getting 119 points out of the money, you're lucky if you get 50 or 60. And instead of getting a 270 credit, you might get $1.50 or more. Did I do the margin wrong? Oh, yes, thank you. Thank you, John. I messed up the margin here because I thought this was 10 wide. 20 wide put credit spread. So your margin is going to be the difference between the strikes, which would be 2,000, less your credit of 270. So that would be margin of 1730. Thanks, John. I was thinking it was 10 wide. So your expiration yield, I wonder if I messed that up. Your expiration yield would be your credit of 270 at expiration divided by 1730. Excuse me, that would be off. It'd be about a 15.6% yield at expiration. That's this green line. This is your expiration graph. This is a Thinkorswim graph, TD Ameritrade. Here's the short strike. Here's the underline at the time, 26.29. So at expiration, your yield would be about 15.6%, $270 and $730. Do I usually wait till expiration? No. So in this particular case, not in all, it depends. In this particular case, if I'm trying to make, since this would be the total I could make, 15.6, I might look to make 7 or 8% of that. So even 7% of $1,730, 1,730 times 7% would be about $120, which would be less than half the credit. So if I was trying to make about 7%, which would be $120 based on capital of 1,730, then I would buy in my credit spread when it went from 270 to about $1.50. I'd look to buy it in, right? $1.50 debit. And, you know, a big issue in the world of credit spreads, how many of you have ever thought, geez, I got a credit of 270. If it looks like the market's stable, just think and wait. Let it expire and get the whole 270. How many of you have ever thought that? Why take it off early? If I'm selling it for 270, why buy it for $1.50? Let the thing expire. How many of you have thought that? Or on your credit spreads, try to just make the whole credit. You know, if things are stable, make the whole credit. Anybody? We're probably all guilty of that, right? But, you know, again, there's nothing wrong with that. I mean, obviously, you know, if I were to ask anybody in here, would you rather make $2.70 credit or $1 or half of that? No one's going to say, Dan, I'd rather make half of that. We'd all rather make it. But again, as in life, as in options, there's always two sides. There's a plus and a minus. And the plus of waiting till expiration and getting your entire credit is you'd make more money. But there's a big negative. Dan, what's the negative? It means you're going to have to be in the trade the entire 30 days versus if I'm looking to make, you know, let's say 7% of the margin, so I'm going to take it off at $1.50 debit, I might get it off in a week. If I get it off in a week, that means I'm only in the trade 7 days or maybe a little bit more or whatever. But what if I'm only in the trade 7 to 14 days? That means I'm not in the trade for 14 to 16 days. Well, can something happen to the market in those 14 to 16 days? Yeah, but I'm not in it, so it doesn't matter. So the risk of holding it to expiration is you could lose everything you made. What offsets that? Having a plan. Having a plan. So does it mean you can't try to get the whole credit? Yeah, but is that part of your plan? Question said, Dan, are your profit, here's a question, Dan, are your profit goals and loss goals always a % of your net margin? Yes. Yeah, because that's the capital you're putting up, right? That's your risk in a credit spread at your brokerage firm is your margin, which is your risk of a trade. So it doesn't matter credit or debit. I mean, obviously credit spreads are always going to be a credit, right? But even if I'm doing a calendar spread for a debit or whatever the trade is, a debit or credit, that doesn't translate into the margin. The margin is your risk. What's my risk in a put credit spread? If I do a 20 wide put credit spread for $2.70, what's my total risk? That's what I'm going to have to put up at my brokerage firm unless it's a portfolio margin account. So that's what we're basing our yield on, right? I mean, if I'm putting up $1,730 for one put credit spread and I make $100, it's $100 on $1,730. I don't say, well, I've got $500,000 in my account. It's going to be, I made $100 on that. No, this is my trade, right? How else would I know how I did on this particular trade? Rick mentioned the theta decay decreases when about 10 days to expiration for plus or minus 30 delta calls and puts. Yeah, and again, it's, the question is, what strike, and we'll talk a lot about this in the credit spread class, do you how do you pick your short strike? Do you go really far out of the money and sell a 10 delta and get less of a credit but a lot more room, or do you come closer to the price? And here we're selling a 20 delta call, which is a 25-10 strike, so we're approximately 120 points out of the money. I could sell a 30 delta put and get even a bigger credit than I'm getting, but now I'm getting closer to the snake, right? So to me, kind of a 20 delta is far enough out of the money, but I still get a decent amount of credit. There's no right or wrong answer. It's just that if you want to get a 10 delta to pick your short strike, in this particular case, would I get further out of the money? Yeah, but my risk reward isn't as good. My theta is not going to be as good. If I'm getting a 30 delta, my short strike could be closer to the current environment, but I get more money. But because I'm closer, there's more risk. So to me, it's trying to find, the bottom line is whether you do a 10 delta credit spread or 20 delta or 30 delta, or 20 wide, 10 wide, or 5 wide, having a good plan. That's the case, right? That's the bottom line. But for me personally, I try to get some probabilities, but I get enough credit so I get enough theta. So it's kind of get a little bit of both. And we'll talk more about that in the class. Yeah, Andy says, which is a great point, there's two things. Andy made a good point. He said, well, you could take it off early and redeploy capital and make more money. Yeah, or you could redeploy capital and you could lose that more money. But that's a good point. Yes, you could take off early and redeploy capital. But it's one thing I'll be talking about when we discuss the plan for a credit spread plan to run a credit spread business. Think about this. If you're doing a credit spread and you put it on a Tuesday and you get your money and you're putting it on, let's say it's a 30-day, every 30 days you're going to put on a credit spread. Well, if you can get out of it early after a week and you've made your money for the month on that 30-day trade, you have no risk for the next 3 weeks, right? So if the market goes down 1,000,000 points, you're out. Now, Andy's made a good point. If you redeploy the capital, you can make even more money. Yes, but for me personally, I like to, if I'm going to put a 30-day trade on, let's say I'm going to put it on once a month or every 2 weeks, once I get my money, I'm out till I go back in the next time. If I'm going to put on let's say a credit spread today's Wednesday. Let's say I'm going to put a credit spread on, let's say today is Wednesday, isn't it? Today's Wednesday, April 25th. So let's say I'm going to go put on a short-term put credit spread. So that would be what, 8-9 days or whatever. That would be expiration a week from Friday. That'd be May 4th. So if today is Wednesday, I believe that would be a 9-day, right? That'd be a 9-day. I think so. It'd expire May 4th. Well, so I'd put it on every Wednesday. You know, if I'm doing a short-term strategy, put credit spread or call credit spread, but I may get out of it by Friday or Monday. And if I wait till Wednesday, right, to put it back on every Wednesday, because today's Wednesday, well, I could be out of the market for a couple days, 2-3 days. So there's a positive to me, days in the trade. If I'm only in the trade 2 or 3 days out of the week, that means if something happens those other 2 days, I'm not in. But you can argue the other point, hey, I'll go back in again, right? And I can make more money. Yes, I personally don't do that, but I have a lot of students that do. All right, let me just get another question or comment, and then because I've got more slides to go over. I don't know if I'll finish all these questions. If I do miss your question, feel free to email me, dan@SheridanMentoring.com. Question from Charles says, does the current implied volatility or lack thereof dictate whether you use this trade? Good question. So Charles says, does the current implied volatility, where are the volatilities trading at? Does that dictate whether you use this trade? Absolutely. And even how I trade it. And that's what we'll talk about in this class, because, you know, as the volatilities are lower and lower, if we're in a VIX 9 to 10 environment, is that going to dictate how far out duration I do a credit spread? Yes. And if the volatilities get low enough, I may do an iron condor alternative, like a double calendar, or a credit spread alternative, like a long Vegas stuff like calendars or double calendars. But I may not use it, right? Or I may use a different type of trade, since it's maybe even a long diagonal, because this is more of a long portfolio strategy, right? There's no risk on the upside. So I may substitute that. So yes, implied volatilities definitely have a consideration when we're talking about how we want to construct it. Couple more points here, and then I'll just power through the slides. So I'll just finish with a few more questions. I'll stop on the questions for a little bit as I go through the next 3 or 4 slides, and once I'm done, I'll answer any other questions. Rick mentioned he likes wider spreads, about 25 to 50 wide. The positive theta is wider. Yes, the positive theta is wider. Your capital requirement is larger also. It is easier to make adjustments when your spreads are wider. I agree with him on that. And for the same risk, one has less contracts, less commissions. Yeah, I mean, there's different ways to do it. And I think during the class, we'll also show you how to look from a volatility perspective at a given point in time. Is it better doing 20 wide, 10 wide, or 5 wide? Sometimes there's a clear winner in terms of which one I would do at a particular time. But the wider you go, it does give you a little more flexibility with the adjustments, but it does cost more versus just doing a 10 wide or a 5 wide. Another comment, or is this a question? Last question, and then we'll finish the slides. The question says, the 20 delta put has about a 40% probability of touching in the next month. Why not go further out in time and increase the distance between strikes to get a 10 delta, which would have the probability of touch, And that's a good point. But again, there's pluses and minuses. I can go further out in time, but it's going to take me more time to get the money. And if I'm trying to bring in weekly money or monthly money, I want to maximize that. And so if I go further out in time and increase the distance between the strikes to get a 10 delta, to get a smaller delta put, but get a little more money, it's going to take me longer to get my money. I'm not going to make as much money. It's, one of it, but it's a good point. Nothing, again, there's always a plus and a minus, right? And, all right, so let's go on to, that was a 20-30 wide put credit spread. How about a 5 wide? What if someone says, you know what, I don't have the capital to put on a 20 wide, or maybe the volatility skew might favor a 5 wide. Here's an example in SPX, with SPX at 2630 of a 5 wide. Again, the delta of, I was picking the short strike by a 20 delta, and I'm selling the 2510 put, buying the 2505 puts. Again, this is a 30-day, so your theta is not going to be a lot to get you excited, but because it is a short Vega trade, you can benefit if the volatility goes down. You're just going to have to be in the trade longer. So here's where the current price at the time was 2630, selling the 2510 puts. This is the expiration graph. The puts are 120 points out of the money. It's a 5-point spread, so my risk on this is 500, the distance between the strikes, minus my credit of 80. So I have $420 margin, which would be a 19% expiration yield on this green graph. The T+0 graph, that's the purple graph, is how your graph will look today. So that's another option. You can do 5 wide. We'll also be looking at during the class Russell. And Russell's a little different price configuration, right? Russell was SPX. If you look at the SPX chart, SPX is already kind of in the lower end of the range of the last 2.5 months, whereas if you look at Russell for the last 2.5 months, we're really not near the lows, right? Like SPX is over the last 2.5 months. So it's a little, Russell acts a little differently. Russell has generally about 20-25% more premium in the options. Moves around a little more, a little bit higher volatility, but I don't think the execution is as good in Russell as it is SPX, but gives you a little bit of diversification, not much. But here would be an example of a 10 wide put credit spread. And again, a little different. This would be a shorter term duration. So I was looking at this. This would be, I put 9-day, but that's not, I think I made a mistake. I apologize for that. I called this a 9-day rut put credit spread, but May 25th is not a 9-day, is it? May 25th would be that'd be about a 30-day, so I apologize, typo there. This would be what? May 25th would be about a 30-day, wouldn't it? Yeah, I'm pretty sure. So here'd be an example of one in rut. If I'm selling the 1510 put, and the delta's around 19 or 20, the short strike. And if I sell the 1510 put with Russell at about 1547, gives me about 37 points out of the money from the strike. Expiration yield would be about 26%, 210 divided by your risk or margin of 790. So we'll be looking at Russell, we'll be looking at longer duration credit spreads, we'll be looking at shorter term, how to determine, do you pick the call side, do you pick the put side, do you do some in stocks, do you do some in indexes, which indexes, and I'll help you kind of set up a credit spread business that you could do on a regular basis. And then also look at stocks. Maybe there's 3 or 4 liquid stocks that you look at. Here's just an example. I'm not advocating this trade. Tesla's are earnings next week. And Tesla's been beaten up a little bit, right? It traded in February up near 360. Now it's, not that far away from 100 points lower. It's kind of been a little bit of a down pattern, right? It's around 279 earnings next week. And, again, I just wanted to show something from the call side. If you said, Dan, I don't particularly like Tesla. I think it's still a little heavy. You know, here'd be an example of a 5-wide credit spread with Tesla at 279. If you thought, even with earnings, that we were going to be below, here's May 4th expiration, that's going to be affected by earnings. Earnings are next week. But if you thought, hey, I think we're going to stay below 305 in Tesla, you could sell the May 305 calls that has a delta of around 22 and buy the May 310 calls. So I'm doing a 5-wide credit spread. For every one contract has $500 of risk. I'm bringing in $100 credit, so my margin or risk would be 400, right? So it'd be about, what's that, about a 20% yield at expiration. Here's your graph at expiration. Here's where Tesla is right now, 279. So I just wanted to bring up an example of a stock and something on the call side instead of just talking about the puts. Earnings are going to be next week, the week of April 30th through May 4th. So these are just a variety of credit spreads. We'll be talking about the setup. Which ones would we pick and how would we pick them and what duration, what strike, all those setup considerations. Then we move into the profit target and max loss. And then we move into, if we were going to adjust, when would we do it? What's the right time? And then, hey, what would we do? So we'll really exhaust ourselves over these 2 weeks. Every class, like I always do, I'll put on a live trade so we can make it practical. And that's it. As far as questions or comments, if you have any questions or comments now, please ask it, or is reviewing the material. We'll have this video available for archive. And as you're reviewing it, if you have any questions, let me know. Neil says, Dan, is there a lower limit to the expiration yield you accept in any credit spread trade? Yeah, I don't personally like to do credit spreads if the expiration yield when I'm starting is, let's say, below 15%. I mean, again, for the risk you're taking, I want to make sure I get at least a halfway decent yield. Ethiop said, would you close this Tesla spread before earnings? Again, I think it has to do with your view, right? Again, if I, for this particular spread, which is May 4 expiration, which would be the expiration week, I'd only put this on if I was going to hold it through expiration, because volatility is not really going to come down that much before the move. So I'd only put this on and go through earnings with it if I felt that with the expected move that we weren't going to go over 305, period. So I would like to close it before earnings. I would like to close it before earnings, but I don't think the volatility is going to come down. So the only way I could probably get this off before earnings, right, would be if Tesla tanked, or went down much. Chris says, why not buy a straddle and at the money call and put in Tesla, since it will be a large movement one way or the other? And Chris is right that probably, if you look historically at Tesla, it can move during earnings. The problem, Chris, is because everybody else in the universe has the same information that you do, that there could be a large move. That's all built in with the premium. So you're basically paying up, right? It's like what would I pay in Chicago for Michael Jordan's last basketball game? Would I pay face value? No. So you're paying so much for the straddle, you need a larger than expected move to make money. So if it just moves what it's been normally moving, you wouldn't make any money because of the extra premium you're paying. So that's why I normally wouldn't buy a straddle at the money for earnings unless I really expected it to move well beyond the expected move. All right. Well, hopefully we can see some of you in the class. I think it should be a great class, a timely class with the market movement and the higher volatilities. And if you have any questions on the class or anything, feel free to send me an email at dan@sheridanmentoring.com. And one other thing just to point out, just a couple events coming up besides this class, which will be starting in 2 weeks. Our Chicago seminar was right around the corner, May 31st, June 1st, 2-day seminar. You can get some information on our website. We have some seats left, not many. It should be a fantastic 2-day seminar. For a price, it's in the 400s. You get 12, 13 different speakers. With that's included lunch and drinks and stuff like that. But it should be a great event. If you can make it, love to have you. Have a great day, folks, and hope to see you in a couple of weeks at the credit spread class. Thanks.